Hello, my name is Revi Damayanti from Accounting Class 23A, with NPM 234120007. Here I will explain the material about financial reports, which include types of financial reports, elements of financial reports, and also the benefits of financial reports including cash flow reports. Here is the material. The types of financial statements include several important components. The income statement shows the company's revenues, expenses, and profit or loss over a period of time, which helps in assessing operational performance. The statement of changes in equity depicts changes in equity over a period of time, such as additional investments or dividends, which is important for understanding changes in equity. The balance sheet shows the company's assets, liabilities, and equity at a specific point in time, providing a comprehensive picture of the company's financial position. Finally, the cash flow statement shows cash inflows and outflows over a period of time, grouped into operating, investing, and financing, helping in managing liquidity and financial planning. These elements of the financial statements provide a comprehensive picture of a company's performance and financial position. The income statement shows the company's revenues, expenses, and profit or loss over a period of time, which is important for assessing operational efficiency. The statement of changes in equity depicts changes in equity, such as additional investments or dividends, helping to understand the development of a company's capital. The statement of financial position shows the company's assets, liabilities, and equity at a point in time, providing a complete picture of the company's resources and obligations, as well as the capital held by the owners. The statement of cash flows shows the cash inflows and outflows over a period of time, grouped into operating, investing, and financing, helping to manage a company's liquidity and financial planning. Next is benefits of financial reports. Performance evaluation financial reports help assess a company's profitability, liquidity, efficiency, and solvency. By analyzing the income statement, balance sheet, and cash flow statement, management can identify areas that need improvement and design strategies to improve company performance. Through this analysis, the company can find out which aspects need to be improved or corrected to achieve better financial goals. Comparison financial reports allow for comparison of company performance between periods and with other companies in the same industry. This comparison helps measure the company's competitive position and identify performance trends. By understanding the company's position compared to its competitors, management can make more effective strategic decisions to improve the company's competitiveness and growth. Decision-making investors, creditors, and management use financial reports to make informed decisions. Investors assess performance to decide on investments, creditors assess the ability to repay loans, and management uses data for operational decisions. Financial reports provide the information needed to evaluate the potential risks and benefits of these decisions, allowing for more rational and data-based decision-making. Transparency financial reports increase the company's transparency and accountability to stakeholders. Clear and accurate information builds trust with stakeholders, including investors, creditors, employees, and customers. This transparency also helps strengthen the relationship between a company and its stakeholders and creates a more ethical and responsible business environment. Next is benefits of cash flow statements. Managing liquidity cash flow statements are essential in understanding the sources and uses of cash, thus helping management manage the company's liquidity. By knowing the cash inflows and outflows, management can ensure that the company has enough cash to meet short-term obligations, such as salary payments, debts, and operating expenses. This helps prevent cash shortages that can disrupt daily business operations. Financial planning cash flow statements are also very useful in short-term and long-term financial planning. By providing an overview of expected cash flows in the future, management can better plan expenses, investments, and financing. This information helps companies plan growth strategies, estimate capital needs, and identify the right time for investment or business expansion. Investment analysis cash flow statements help assess a company's ability to make investments and pay dividends. By knowing the available cash flow, management can evaluate potential investment projects and decide whether the company has sufficient resources to fund them. In addition, cash flow information allows companies to determine the right dividend policy, thereby providing added value to shareholders. Decision-making cash flow information is used by management and investors to make informed decisions. Management can use this data to identify areas that need attention, such as reducing costs or increasing revenue. Investors also look at the cash flow statement to assess the financial health of a company and determine whether it is worth investing in. Thus, the cash flow statement is a very useful tool in making informed, data-driven decisions. Financial statements come in several types, including the income statement, statement of changes in equity, statement of financial position, and statement of cash flows. Each of these statements provides important insights into a company's performance and financial position. The income statement shows revenues, expenses, and profit or loss over a period of time. The statement of changes in equity depicts changes in a company's equity, such as additional investments or dividends. The statement of financial position shows a company's assets, liabilities, and equity at a specific point in time. The statement of cash flows shows cash inflows and outflows, grouped into operating, investing, and financing. Benefits of financial statements include performance evaluation, which helps assess a company's profitability, liquidity, efficiency, and solvency. They also allow comparisons across periods and across companies in the same industry, helping investors, creditors, and management make informed decisions. In addition, financial statements increase a company's transparency and accountability to stakeholders. The statement of cash flows, in particular, helps in managing liquidity, financial planning, investment analysis, and decision-making based on available cash flow information. Overall, financial statements are a critical tool for understanding and managing a company's performance and financial position.